Good morning and welcome to this Monday, July 6th, 2020 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, I'll tell you what, before we get into what happened on Friday and what we're looking at today, I do want to mention to everyone that if you go over to EarningsBeats, and I will show you, well, eventually here, there we go. If you go over to EarningsBeats, to our homepage, you'll see we've got a big webinar coming up this afternoon. So today, I'm not just going to give you a look at what I'm seeing today, but later today, I'll give you a look at what I'm seeing in the second half of the year. So it's going to be a pretty big webinar. It's a pretty all-inclusive type of review. Try to take a look at a lot of areas. You can see many of those areas listed here on our home page. If you want a little bit more information, you can just click to go into the page, which shows a little bit more information. One of our flagship chart lists is our strong earnings chart list, and from that we develop portfolios. And our key portfolio, I would say, the one that we began back in November of 2018, our model portfolio was really born out of just picking 10 of my favorite stocks off of the strong earnings chart list. And I just make sure I pick them out of different industry groups. And every 90 days, we switch them out and put in new leaders. And this performance since November of 2018 has been rather remarkable, with the model portfolio now up 107.36%. That's through the close last Thursday, before the holiday, and you can see the S&P 500 up only 16.33% during that time frame. So pretty interesting outperformance. And you can just look at the chart, the visual, and you can see we actually broke out to a new high back in early May, even with the pandemic. The S&P 500 still well below that February high. So what I've learned from a couple of really bad periods in the market since we've had this model portfolio, if you remember back in December of 2018, the S&P lost 20% in a month back with the trade war. And it wasn't that the model portfolio was immune. You can see the pullback there in December. You can see the one back in February into mid-March with the pandemic. It's not that the model portfolio is immune and doesn't go down, but what I think it teaches all of us is that when the market comes back, usually Wall Street will look for those leaders first. That's where the money comes back in. And you can see that the model portfolio actually broke out to a new high in January of 2019. The S&P didn't do it until the end of February, early March. So the leaders came back first. We just saw it again. And by, like I said, early May, we were breaking out on the model portfolio. Here we are a couple months later. We still haven't broken out on the S&P 500. So just wanted to point that out. We've got a really good session coming up later today. So if you're a member of EarningsBeats, hopefully you can tune in at 4:30 this afternoon. If you can't, we will be recording it. And for those of you maybe that aren't currently EarningsBeats members, it'd be a great time to join. We do have a special running $7 30-day trial, and your $7 is even refundable. So it's really a zero cost trial. I think you'll enjoy it. All right, let's get into the action from Friday. It was, I'd say it was a pretty good day for the market. We did have outperformance again by the NASDAQ, as you can see, gaining a little bit more than 0.5%. The Dow was up about 1/3 of 1%, S&P a little less than 0.5%. But overall, we continue to trend higher, which is really important. Every area of the market, all of these different indices, all the major indices in the US, trending up above the 50-day moving average, and for the most part above the 20-day. You can see the mid caps and small caps struggling a little bit, but for the most part, the trend is intact. We're going higher. The market looks good, in my opinion. As we move to the sectors, it was interesting on Thursday. Friday was a holiday. So on Thursday, you can see materials and energy leading. That's kind of a strange combination. Materials have done much better than energy, by the way, and you can see materials on Thursday breaking out to about a 3 or 4 week high and not far from challenging that early June high. Energy, on the other hand, has been a little bit more difficult recovery. And in fact, this is the one area of the market still struggling right around its moving averages. Industrials also had a good day. This is another group that had been beaten down on a relative basis. All these groups, by the way, are trending higher. But on a relative basis, industrials have been beaten up a little bit. And then the two worst performers on Thursday were real estate and communication services. But once again, just like the major indices, when you look across, really all of these groups are showing higher highs and higher lows, even energy, even though it's, been beaten up and on a relative basis doesn't look very good. Everything is in an uptrend. And that's the really, when you talk about a bull market, that's what happens. Everything goes up. Rising tide lifts all boats. But you still have pockets of relative strength, pockets of relative weakness. And our goal is to try to stick with the relative strength as best we can. All right, looking at the 10-year Treasury yield, give you an update that was from earlier this morning. Strong. Right now we're up 4 basis points to 0.71%. Good news for the market. Anytime you've got the 10-year Treasury yield moving up, means money's rotating out of Treasuries. And when that money rotates out of Treasuries, history tells us more often than not, it goes into equities. So it's always nice to see this 10-year Treasury yield rising. And this is the thing that I think really underscores that we're in a secular bull market and not in a bear market. This is really important. In a secular bear market, when we see the 10-year Treasury yield drop, that means money's rotating into Treasuries. During a bear market, the money comes out of the stock market. Stock prices plunge. We saw that initially back in March, but after the quick rebound, you can see there really hasn't been a flight out of Treasuries. We haven't seen the 10-year Treasury yield moving higher by any stretch. And yet stock prices have rebounded very nicely and in many cases have actually broken out above February highs. So the stock market's going up without rotation from Treasuries. It's just money on the sidelines or new money that's coming in. It's not rotation. The most powerful moves in the stock market come when you get the rotation out of Treasuries. And that is shown with higher yields. That's how you know Treasury prices are going down and money is rotating when the yields are going up. So keep watching this because I think the best is yet to come. I really do. I think that there's been a tremendous amount of cash that's gone into 10-year Treasury yields. I can't imagine investing in something that's going to pay me 0.71% per year for the next 10 years when I've got Netflix and Tesla and Apple and Microsoft and all these companies growing their earnings so rapidly. That's the divergence. We're seeing money pouring into those companies, but it's airlines and hotels and those companies that truly do have issues, fundamental issues, technical issues. Those are the companies you got to be careful with. But when it comes down to investing in a 10-year Treasury bond or Apple, I mean, there's no choice in my opinion. And I think eventually we're going to see that. We're going to see money rotating out and into these stocks, especially as we get the virus behind us. Now, I know we've still got another several months probably ahead of us, but I think what happened is the market really discounted a lot, thinking that this virus was going to completely shut everything down for a long period of time. And as we've gotten more and more information, while it's bad and it's horrible from a healthcare perspective, I think from a financial perspective, Wall Street is saying, hey, we're going to get beyond this. It's not going to be nearly as bad as we thought. And eventually all these other companies, their earnings are going to explode. We've got a strong economy, low interest rates. We deserve high PE multiples. And that's where I think we're heading. Let's keep moving on. Let's move on into talking technically. I just want to pull up the S&P 500. This is a 1 hour, so 60-minute chart. And you can see right now the PPO on the S&P is going up while we're moving up. This last high right here, the PPO was still rising above the center line. So once you get back to the center line, your momentum at that point is zero. I always look at what's going on from the center line forward. So in other words, some might look at this, well, we're not at a higher high. But if this was higher than this, some might look at it and say, oh, but our PPO is much lower than we were over here. That's a negative divergence. I think on an hourly chart, why are you comparing July 2nd back to June 9th? I mean, that doesn't even make sense to me. We've had so much, we've lost all the momentum, regained the momentum, lost the momentum. I mean, looking at, July 2nd versus July 8th, 9th, or June 8th, 9th makes no sense to me. So here's what I'm concerned about. This is a fairly short-term chart. I've got the PPO through the center line rising, telling me that short-term momentum is with the bulls right now. And as the S&P pulled back at the end of the day on Friday or Thursday, you can see we held on to gap support. We held on to the rising 20-hour EMA. And now today, futures are pretty strong. Last time I looked, I think the S&P was looking to open up maybe 40 points. So we're looking at a breakout above all of this overhead resistance right here. So I think the S&P still looks really good. Yes, there are pockets, again, I wouldn't touch. I'm not a big fan of the airlines, the cruise lines, hotels, gambling, banks. I think banks are struggling. Although if we get the 10-year Treasury, 10-year Treasury yield moving up, that will certainly help. All right, let's keep moving on here. I tell you what, I want to talk a little bit about my blogs, because I don't know, even with our members, I don't know if you realize how often I post blog articles and where I post blog articles. But if you go over here to stock charts, just to your dashboard, and click on the articles, I write in 3 different blogs. So I write in, of course, Trading Places with Tom Bowley. So you can go in here. Typically, I used to always post every morning at 9 a.m. back when I was actually working for stock charts. Since then, though, now I'm over at EarningsBeats. I write a daily market report every day. So I don't post over there consistently. And I don't post over there in this blog very often, but maybe once or twice a week, I try to post something. And I did post a couple articles last week. And if you go in here and you go down to the bottom of these articles, actually it doesn't show up here because I'm probably, I had already subscribed to my own articles just to make sure that I was getting them. But down below where I sign, if you go in, you should see a spot where you can sign up. And what that does when you subscribe, all you do is you put in your email address and maybe name, I don't know, but I know it's the email address. But once you subscribe, what it does is it'll send you the article as soon as I publish it to the email address you provide. But looking at this particular article, I just indicate, hey, there are a couple of small companies that if you're an aggressive trader, you might be interested in. FLDM, this is in healthcare, but it had a really nice move up from March to May, and it's been consolidating, and it looks to me like it's broken out of this bullish wedge where you can see this like piece of pie squeezing after an uptrend. But I like that breakout right there, and volume has been picking back up again. But that one I thought looked pretty interesting. And Pluralsight's a software company. Now, it hasn't been a great performer in software, and you can see it relative to software had been going down, but for the last few months, it's been coming back up again. And during this period, had a great uptrend, and you can see on a relative basis was doing well, but it's been sideways consolidating, maybe even in a cup, which could take us back up to about 22 area. And if that happens, watch this relative strength, because if it turns back up and eventually makes this breakout on a relative basis, and then we can get through these this price resistance area between 21 and 22, I think this is one that could go. But again, it's, there are a lot of other software companies that look better, and I don't want to say are less risky, because software as a group is pretty risky just because it's gone up. They've gone up so much, and there's so much built into their future earnings. These are, high growth companies. If you think the market is going to be weak for the next year, then, you're probably going to be a little scared of these software companies because there's a lot of future growth built in. I tend to be much more bullish about the economy and about earnings growth, and that's why I think these companies deserve these high PEs. But I've been wrong before, and I might be wrong again. You have to do your own due diligence, your own homework, and follow what you believe. But anyway, those were a couple of stocks that I had pointed out. So I just wanted to make sure that you knew that that these other blogs and articles are available out there. I had written also about, what that I just mentioned, the PEs. I think the PEs are going to drive. I think PEs should be much higher in this environment. A lot of folks are saying, oh my gosh, PEs are 26 now. It's too much compared to history. Well, I can't think of any other time in history when we've had interest rates at 0 with the Fed saying they're going to stay at 0 for 3 more years, 2 to 3 years. If that happens and growth continues, 26 PE isn't high at all for companies in this environment. So anyway, I wrote an article about that. Also, you can check out, I talked about the NASDAQ and the internet and software all having negative divergences. Did I believe that that meant that prices had to come down? No, but it does at least tell us that we've got to be a little careful in the short term. Now, internet, of these three, internet actually did what I thought it might do, which was go down and test the 50-day. When you get a negative divergence like this, higher prices, lower PPO, and notice I'm not comparing the PPO and price action to over here. I'm just, looking at the last few highs. And so as long as that PPO is above the center line and kept drifting lower with higher prices, you got to be aware of potentially a 50-day test. So see how we kept holding the 20-day on the way up, get the negative divergence, and then all of a sudden we go right through the 20-day down to the 50-day and the test gap support? That is more of what I would look for. This doesn't mean long-term bear markets coming. It means a slowdown in momentum, temporary. Could be long-term, but I don't see the other signs that support that theory. So I was looking for temporary weakness. We got it here down to the 50, and now the internet stock's trying to break back out again. Also, let's go back over here. Also, in addition to Trading Places with Tom Bowley, of course, every other weekend I write at Chart Watchers, or in the Chart Watchers newsletter, and the weekends I don't write, my partner John Hopkins writes. So we always have an article going into this every week. And this last week, over the weekend, I said one thing always drives stocks higher, and it'll happen again during the 2020 second half. And I think it's going to be a reduction of fear. The VIX doesn't stay elevated for long, long periods of time. Now, it'll stay above 17 to 20 in a secular bear market. But that normally will go for a couple years, maybe a year and a half to 2 years, something like that. Cyclical bear markets don't last very long. And usually when you get a cyclical bear market, you get a sudden pop in the VIX, and then we just work our way back down. And when we work our way back down, that's usually when the stock market does its best. So you can see here on this bottom, the final bottom that went in 2009, you can see as the VIX just kept working its way all the way back down to 15. Look at what the market did. Same thing has been happening here. When we got up to 85 and we saw the VIX come all the way back down, we're at 27 and change now. You can see what the market's doing, back to the upside. So we're having little bouts of movement back to the upside on the VIX periodically, but the overall trend is down. And I think that's going to continue in the second half, and I think that's going to help spur the S&P 500 to new highs. But anyway, Chart Watchers, again, make sure you subscribe. Let's see if it's on here. Yeah, here it is. So underneath, about the author, if you come down, you'll see subscribe. Just type in your email address, not even your name. So no credit card, just your email address, subscribe. And what happens is as soon as I publish the article, it'll be sent. So that way you're getting these articles, because again, these are not consistent always, especially in my Trading Places blog and in the Don't Ignore This Chart blog. And I don't post this one very often. I'm going to try to start posting it a little bit more often. But there are other authors as well. Julius, I know, posts a lot in the Don't Ignore This Chart. I think he posts about every Thursday. So I'm going to try to start posting once or twice a week in here as well. But again, if you, and this one I was looking at the transports, something I'll be talking about later today. But again, you go down to the bottom and you can subscribe. So all these blogs, you should be able to go down to the bottom and subscribe. Make sure you're getting the latest. All right, let's keep moving. Earnings spotlight. Let's take a look at the paychecks. Now, there are no earnings coming out today, or nothing of any significance today. We're starting to get close, though, to earnings season. We're now into July. Usually around the middle of the month is when it starts to kick in. So we got about another week or so. This week, tomorrow, paychecks reports. Later this week, we do have a couple of others. Delta Airlines will be reporting. Walgreens, Boots Alliance, WBA will be reporting. So we've got a couple of, actually another one to watch, I think, is Bed Bath & Beyond. Very, very heavily shorted stock that's been making a move up into its earnings. It's going to be very interesting to see how that earnings report comes out. But let's take a look at some of these ahead of time here. So we've got Paychex. Now, if you look, the software, it's part of software. Paychex, well, software index has been moving up relative to software, and Paychex is, you know, it's an established business. A lot of the software companies that are outperforming the software index are mostly, I'm not going to say new software companies, but they're smaller. So their revenue growth, their earnings growth is much greater than a company like Paychex. So Paychex is going to struggle to keep up with a software index. The overall absolute chart on Paychex to me looks pretty good. We haven't gotten back to the February high, which a number of companies have, but I think you got a pretty nice channel that started here. Nice move to the upside. Watch the 50-day moving average and maybe this breakout around 69.70. I think that's an area that you want to keep, you know, pretty close eye on. But other than that, I think Paychex looks pretty good as it heads for its earnings report. Let's see, what else do we have? Let's look at that Bed Bath & Beyond. So very, very heavily shorted stock. And I can tell you how heavily. Let's go over to this short squeeze chart list that we have. It's the third highest shorted stock in terms of short percentage of float. That's what this 61.94% in the title here represents. So this company has 61.94% of its float short. Now that was as of the beginning of June, I think. So we'll probably be updating this list again pretty soon. But that is pretty impressive to have that much of your float short. And anybody who's been shorting has really begun to feel the pain because Bed Bath & Beyond is looking pretty good technically. The other thing I like about this stock, and you can see relative to its specialty retail peers, it has been gaining ground now for 3 months. So it's not just going up because specialty retailers are going up, it's been leading specialty retailers to the upside. And when you look at specialty retailers versus the S&P, just last week we hit a 52-week relative high. This is one of the strongest areas of the market. And Bed Bath & Beyond has been showing leadership. Now, is it a lot of folks buying, or is it just the fact that a lot of shorts are covering? We'll probably find out with that earnings report, but if they have a strong earnings report, there are going to be a lot of shorts that are not going to be happy. So Bed Bath & Beyond will be one to keep a really close eye on. Another airline, I mentioned Delta will be reporting on Thursday, but Wednesday, it's AIR. AAR Corp will be reporting. Let's get a daily chart. So we had the breakout, we had the pullback. This is going to be the first report. I'll tell you, the one thing that's still bothering me a little bit here is that even when the stock was going up, look at the AD line continuing to go down. So a lot of the strength was coming in at the opens. We have this one really big hollow candle, so that shows buying throughout the day. But a lot of these others, you can see these tails to the top or red filled candles. That's telling you that the stock reversed off of earlier highs. So, and as we move back down, you can see a lot more red filled candles and the AD line moving to a 52-week low. That makes me a little nervous because it's almost as if, you know, it's the opposite of what was happening back in March and April. Instead of gapping down, you know, we had a lot of really strong companies that were gapping down and then stocks were being bought during the day. This seems to be the opposite of that, where we're getting gaps to the upside and then failing throughout the day. And that reeks of distribution to me. So I'm really concerned about these airlines when they start reporting earnings. I don't think, I mean, how could they possibly have anything good to say? Seriously. I mean, there's no way. They've lost 95% of their business. Now things are starting to pick back up a little bit, coming back a little, but they're, you know, looking back at their past 3 months, I mean, it's going to be horrendous. And I just don't know what they're going to say to make anybody want to buy. They're certainly not going to say anything that's going to make me want to buy. So got that coming up. We've got Delta Airlines, which I mentioned, DAL. So we look at this chart. Now this one's a little different. At least it's shown a bounce back in the accumulation distribution as opposed to AAR. So just looking at that and nothing else, would tell me I might feel a little bit more comfortable being in Delta Airlines, but I'll be honest, I wouldn't be comfortable being in any of them. Another company, and this one, HELE. If you go down, actually, let me pull it up on a relative basis. They're going to be reporting on Thursday, and you can see relative to the S&P 500, just set a new 52-week high. Relative to its peers, it's been moving higher, higher lows. We're not at a higher high at this point, but I think still, given that the group's been moving up versus the S&P, and this stock's been moving up versus the S&P, I would expect to see a pretty good report coming out of Helen of Troy. So that's on Thursday. Next week is when we're going to get the big stuff. Pepsi comes out on Monday. Slew of banks, big banks, comes out Tuesday. JP Morgan, Citigroup, Wells Fargo. I don't know that those reports are going to be very strong. I think banks are going to struggle a little bit. The ones I'll be looking at next week, eBay. I think eBay comes out next Wednesday. And you can see the performance. This has been I remember writing about this stock when we broke out above the 38 level, maybe even before that. eBay was starting to show a lot of good strength. You can see, we had gone out. Right now we're breaking out to a new high in the AD line. I think there's been a lot of accumulation. And of course, eBay is the type of company that would do well during a pandemic. It's online. So this is going to be interesting for some of these pandemic stocks, just to see how much eBay has grown their earnings in this environment. So keep a very close eye on this one. Another one, and this will be the last one I want to bring up, Netflix next Thursday. I mean, seriously, Netflix, a lot of folks can't go to theaters. So a lot of folks have been subscribing to Netflix. This is going to be another one for those stay-at-homers or the social distancing, the paradigm shift kind of stocks. Netflix is going to be a poster child for the upcoming quarter. So going to want to pay attention here to see how they do and how the market reacts. All right, a couple upgrades, downgrades, and I'll get into the three you must see. CYBR, and I'm going to just pull these up in symbol summary so we can see what we're doing pre-market here. CyberArk software up $2 this morning pre-market. I see, move up and maybe equal lows, double bottom. Needs to get through about 106, 107 on a closing basis. So this is at least a start there. Another upgrade, Tandem. It's a healthcare company. Stock up $4. That broke out last week. I didn't even see that one. That's a really nice breakout in the stock. Great volume. I think this chart looks great. And then another upgrade is US Silica Holdings SLCA. Smaller company. Stock up 4.5%. Been in a nice uptrend. It's got great support down around 320, 325. Stock is up a little bit on an upgrade this morning. Now, these were some downgrades, and I thought these were interesting because they're all, pretty heavy stocks that have been moving up. Fastly, I don't know. This is probably a buy point. I'm kind of being a little facetious, but also semi-serious. Stock has not pulled back much in the past few months. It is down a couple percent today. We'll see. 20-day moving average is where I'd be most comfortable taking a shot there. Netflix. Just talked about Netflix, but it is up $4 on an upgrade today after breaking out last week. So Netflix looking pretty good. And then Spotify, another one that's been absolutely on fire, down $2. Major buy. Again, somewhat facetious. But Spotify's been great. Watch that 20-day if it does get down there. Okay, three you must see. Let's wrap up the show here. And first thing I'm going to do is bring up TTNP. So this is Titan Pharmaceuticals. I don't talk about these stocks very often. 30-cent stock. I would not buy it. I don't buy these kinds of companies, but I'm sure there are plenty of you that do like these little companies. It's got an uptrend. Volume has come into the stock on these pops to the upside fairly frequently, and the stock has gone down from about 45 cents to 30, which is about a third of the value of the company. And this is an area where the volume came in last time. So 28 to 30 cents seems to be a pretty good area of support. I just wanted to mention it. Again, not really my shtick, but some of you might like those kinds of stocks. Next up, Spirit Realty, SRC. If you look at this one, and especially on a relative basis, this stock relative to the retail REITs has been on fire. So you got one of the leaders in the group. Now, the overall group itself hasn't been that great versus the S&P, but I'm kind of looking at this as a symmetrical triangle. you know, lower highs, higher lows off of an uptrend. So watch for a breakout here. I wouldn't be surprised. It's not, again, not one of my favorite areas of the market, but it is, you know, at least a leader among its peers. And then the last one I have here is X-ray, which is Dentsply. This is another one that I think looks pretty interesting after the pullback, sideways consolidation. I think if it gets above $46 here, it's going to make another run for 51. That's what I'd be looking for. I'm not going to annotate it, but if you connect these highs and these lows, I think you have a really nice channel going up as well. So X-ray wanted to point out. All right, that's it. We have the market is open. Let's see where we are right now. Dow up 365, S&P up 42, NASDAQ 152 points, NASDAQ 100, 144. You can see everything up more than 1%, and small caps, mid caps up around 2%. VIX back down to 26. And remember that 24-25 area has been really good support on the VIX. If the VIX breaks down below that, we could be seeing, you know, could be a melt up to the upside heading into earnings. So with that, going to wrap up. Don't forget, later today, 4:30, going to have a great webinar. I love these, you know, outlooks, whether the beginning of the year, mid-year, whatever. Gives me an opportunity to really take a look at a lot of different things going on. So if you're not familiar with it, you're not familiar with EarningsBeats, go into EarningsBeats.com. You can go to the main page right here. You can sign up. You can also sign up for our free EarningsBeats Digest newsletter. Anyway, that's it for today. Everybody have a great day. Hopefully see you later today at 4:30. Happy trading.